Start off with the number that came through for December. I mean, we're looking at 3.5%, and that's from 3.6% the previous month, slightly more benign than most had expected. And this is in the midst of all the worries coming through from the Eurozone, from China, and especially the UK in terms of inflation creeping through into the economies.
Yes, indeed. I think if you look at the range, the market expectation was anywhere between 3.4 and 3.8. And a lot of analysts actually was afraid that we could see an upward jump in the inflation rate. As such, I think 3.5% proved to be quite a good number. And if one look at the components, of course, food inflation is still the major category, about 16% of the total basket, and that has been at 1.5% now for the past 2 months. So really not much pressure coming in on the food side. And then, of course, some of the other categories that we've become accustomed to now actually do tend to push up the inflation rate a bit. We see of course, the electricity prices are still rising at the rate of about 18%, so the cost of household operating costs, that is above the target level of 6%. And then other more administrative costs, such as education and health and so forth, those are also fairly high, above the top inflation target range.
You know, going into this year, and many were of the view that we could see another interest rate cut in South Africa, given the fact that the inflation outlook very benign. Given the fact that food inflation is still also on the lower end of the spectrum, as you mentioned, administered prices though could start edging up going into this year. But food inflation seems to be a very big reality for a lot of the emerging market economies. Do you think that at some point it's going to filter through, or does it hinge on the fact that the rand is still very strong?
No, the rand is definitely, I mean, that is the single most important factor that has caused inflation to drop to these levels and that are maintaining us at fairly low levels of inflation. Food prices are escalating at a rate of 35% already internationally in dollar terms. That has already affected probably a lot of the developed economies, and some of the emerging market economies are showing signs of increasing inflation. And we've seen all the problems with the weather conditions. Now, rain is good for crops, but too much rain can also be harmful. Fortunately, we've had an excellent crop last year, the biggest since about 1980, so there's lots of maize. But of course, the effect of parity pricing, international prices, I'm afraid later in this year we will start seeing the effects coming through in inflation, probably from the middle of 2011 onwards. And that is surely going to play a role, together with the rand that we also foresee that may be slightly depreciating in the second half of 2011.
Christo, we'll pick up that point with you in just a little while. We're now heading off to London. Asset management company Silk Invest has recently announced its intentions to launch a private equity fund that will invest in African food companies. Standing by in London to discuss this with me, as well as what the company has planned for 2011, is Zin Bekkali, the CEO of Silk Invest. Zin, thank you very much for joining us today. I'm sure you could hear a little bit of that conversation. We're talking about food inflation becoming a reality for a lot of the frontier markets and emerging markets. It seems that Africa for now is relatively resistant to food inflation, with the exception to some economies. You're planning to launch a food fund. Tell us a little bit more about it.
Yeah, it's actually the food is a big topic in our markets today. I think what we are looking at from the opportunity point of view, there's a lot of food and beverages companies in Africa today who are trying to substitute imports from different outside countries, and that is a great opportunity for investors. You know, we are talking about a big population which is increasingly able to buy packaged, branded products in the continent.
Well, it's quite interesting. I mean, looking at Africa, it's a really big food importer of food. Do you see that changing? And then also just looking at the prospects for some of these companies doing relatively well, which areas are you focused on?
Yeah, I think, first of all, I think basically the food industry in Africa, if you look at the food and beverages companies, they are growing around 20% every year across the continent. So it's really a segment which is where there is at least as of today, more demand than supply within the continent. So that is one thing which is a big driver of the future opportunity. If you look at it from just to give you some examples, if you wander around in a supermarket in Nigeria, most of the products are still today coming from outside, and that needs to be replaced. There should be more products from the local markets, focusing on the local consumer over there.
And I mean, you mentioned Nigeria as an example. Which companies are you going to be including in this fund?
So which countries, or
which
so
companies?
The country specific. We are focused. So we're we are just mainly focused on privately held food and beverages companies. So what you should think about products like water, mineral companies. We are talking about companies servicing, for example, simple things like biscuits, like confectionery. You are talking about companies like milk producers. Retail could be an interesting sector, especially restaurant chains type of companies. So it's a actually, within the food industry, you have a big range of potential companies. What the fund doesn't do is invest in, let's say, the commodity play. So it doesn't really invest in agriculture. It doesn't invest in farming. It's really the closer it gets to branded food products who are close to the consumer, the better for us.
Let's touch on the overall economy, the global economy. We're seeing developed markets coming under significant pressure, and emerging markets have definitely outperformed the developed world over the past year or so. Frontier markets have done even better. There is a lot of concern that when we start seeing a rise in inflation, and perhaps when we start seeing the developed economies starting to raise interest rates, that we could see investors liquidating their positions in emerging markets and frontier markets. Are you concerned about this going forward?
I think there are challenges, specific challenges within these countries. I think there's something which people that's understood. But I think what you should look at is how frontier markets are today versus the other places. And you look specifically at valuations. These markets are probably the best place to be for 2011. And that is really the main theme that we try to explain to investors is, if you look, for example, from a dividend yield point of view, most quoted companies in Africa have dividend yields of 4 to 6%, whereas like a country like India, they are close to 1%. So that is something which is very important to take into account when you're looking at asset allocation for 2011.
I mean, going forward, I mean, looking at the risks that could come to the fore as well, as I mentioned, one being liquidation of positions if something does shake up the rest of the world. It seems that two economies that you're really bullish about, we're looking at the likes of Kenya and Ghana. You're expecting returns of around 40% into this year.
Yeah, those numbers may sound very bullish, and they are. But I think, again, you should really look at the starting point. These markets, typically most frontier markets in Africa, Middle East, or even Asia, they didn't really receive any money or real money in the last few years. Most of the money that went into emerging markets went into the big countries, whether it's Brazil or India or China or even South Africa. So the frontier markets still didn't catch up with those markets. And your point about getting money out of those markets, I think, is relevant. But the question is what happens with the money that leaves EM. Does it come back to Europe or US, or doesn't go to other places? And we think it will go to other places, and those other places will be mainly in Africa in that sense. And Kenya and Ghana are fantastic examples of that. I mean, Ghana is still selling at close to its lowest point after the crisis. And the economy is growing by around 10%. So it's a fabulous place to build some positions in 2011.
Zin, I mean, looking at the currency volatility on a global level, it seems that it is here to stay. On the other end of the spectrum, you are expecting currency appreciation in these markets to be between 1 and 3%. We also know that the likes of Kenya and other central banks on the continent are very much involved in ensuring that there isn't a lot of volatility in their currency. Tell us about the returns when it comes to dollar returns versus local currency returns.
Yeah, I think in our markets, the good thing or bad thing is that those markets, they don't have, let's say, flexible or floating currencies. They are very much managed. And in the old days, all the big institutions would say there's a bad thing, but I think the World Bank is now almost telling Brazil and South Africa that they need to manage their currencies in a more fixed way. But the point that I wanted to make is that basically the frontier markets currencies typically don't move too much versus the dollars. So they have, for example, as of today, they are still selling at the lowest points versus like 2008. They are around the same level. So they didn't have that move that we saw in the rand or we saw in the Brazilian currency. They're still at the lowest levels ever. And from that point, we think that if there is one part of the world that you can see any appreciation in terms of emerging markets or frontier markets, then probably frontier markets will be the place again to see that type of move.
Zin, it was great to have you on the program. Thank you very much for joining us. That was Zin Bekkali, the CEO of Silk Invest. Now back to our inflation conversation with Christo Luus, economist at Ecoquant. Christo, thank you so much once again for being here today. I mean, you heard part of that conversation, a lot of bullishness regarding the frontier markets. One of the questions I did pose to Zin is the liquidation of positions in Africa if something does shake up the developed world, like an interest rate hike, for instance, and perhaps even the fact that yields will look far more attractive in the developed world going forward than what they do in the likes of emerging markets and frontier markets.
Yes, I mean, it's undoubtedly true that risk appetites have been increasing of late. The problem is, of course, that the returns are not there. So investors in developed countries have looked towards emerging markets, and as you've mentioned, also the frontier markets now. And that is, I think, where returns will be much better for some time to come. All the policy problems, the issues with high levels of indebtedness, low interest rates, those are things that definitely are going to weigh still on especially a place such as Europe. Probably we will see a much better performance of the stock market in a country such as the US. But for the rest, I think if investors want diversification and they are willing to take on additional risk, we could see emerging markets doing well.
I mean, we mentioned the inflation and the inflation outlook going forward into South Africa into 2011, but at the end of the day, we've got interest rates at 30-year lows. We're sitting at 5.5% on the repo rate. Do you think there's another chance of an interest rate cut? And should we see another one, what would it do to the bond inflows into the country and also to the equity inflows?
Yeah, so, you know, we have seen bond yields edging upwards. That's been despite the low interest rates, lower inflation, strong rand. The major reason is that there's a big supply of bonds coming onto the market, and it's not likely to end soon. For the next couple of years, it will keep on coming into the market. So from the demand side, I think it's going to put pressure on our bond yields, and especially if we should get some additional inflation later this year, that should also be negative for bonds. As far as the short-term interest rates are concerned, I think, you know, today's figure will, for all intents and purposes, count as just stable inflation. It's not going to massively influence the Reserve Bank decision. So they will see inflation as being stable, and as such I don't expect that to have any impact on their decision, which should be keep interest rates on hold.
Retail sales set to be released later on today. We're expecting a number of 6.8% for November. Is this your expectation? I
think it could be close to that, in that vicinity. December proved to be quite a buoyant month for most shops. If you just visited the shopping centres, you didn't get parking at times, so it should have been a good month for retail sales.
Christo, thank you so much for joining me today. Much appreciated.